Sustainability isn't just about the environment. It's reshaping the future of businesses. For chartered accountants, it's now a core part of financial leadership.
Investors, regulators, and clients demand transparency in sustainability performance. Chartered accountants play a key role in measuring, reporting, and ensuring sustainable business practices.
Climate risks, carbon pricing, and ethical supply chains directly affect financial stability. By integrating sustainability into audits and strategy, chartered accountants help businesses stay resilient and compliant.
The profession is evolving. Sustainability reporting is just now as critical as financial reporting. Accountants, let's be equipped with skills to lead this change because the future is sustainable.
Join the movement.
Join the movement.
Join the movement.
Join the movement.
Lead with sustainability.
Sustainability isn't just about the environment. It's reshaping the future of businesses. For chartered accountants, it's a core part of financial leadership.
Investors, regulators, and clients demand transparency in sustainability performance. Chartered accountants play a key role in measuring, reporting, and ensuring sustainable business practices.
Climate risks, carbon pricing, and ethical supply chains directly affect financial stability. By integrating sustainability into audits and strategy, chartered accountants help businesses stay resilient and compliant.
The profession is evolving. Sustainability reporting is just now as critical as financial reporting. Accountants, let's be equipped with skills to lead this change because the future is sustainable.
Join the movement.
Join the movement.
Join the movement.
Join the movement.
Lead with sustainability.
Okay, good morning, everyone, and welcome to today's webinar on IPSAS 47 revenue. I am Tariro Mandea, and I will be the moderator for this session today. And as always, we're delighted to have you to just get into the detail pertaining this crucial standard for public sector accounting. And we find that IPSAS 47 is a significant development, replacing the previous standards that were there, the IPSAS 9 on revenue from exchange transaction, IPSAS 11 and IPSAS 23. And today we will be exploring just the core principles of IPSAS 47, focusing on the two distinct accounting models, which is one for transactions with the binding arrangements and another with transactions without binding arrangements. We do encourage for you to just submit your questions throughout the presentation using the question and answer feature that is there. And at the end, we will just dedicate some time, or rather a slot at the end, to address as many questions as possible. And do feel free to come out live and ask your questions. Now, without any further ado, it is my pleasure to introduce to you today our speaker for the day. And our speaker for the day is Timothy Dandira. He is a chartered accountant, Zimbabwe. He is the head of professional education at Elchad Business School, where he leads the development and the delivery of professional accounting and public sector finance programs. He does have very extensive experience in financial reporting in both the IPSAS and the IFRS, as well as extensive experience in auditing, corporate governance, and public financial management and professional education. He is very much a passionate advocate in accountability and sound financial management, and he does believe in high quality financial reporting and governance. Timothy joined us today as a presenter for our IPSAS 47, And he brings not only the technical authority of the standard, but a genuine commitment to making public sector accounting excellent, especially for our reality in Zimbabwe. Timothy, good morning. Welcome.
Good morning, Harry. How are you?
I'm great, thank you. You can take over.
Thank you so much for a wonderful introduction. Please, what our attendees, it's my pleasure to be here and appreciate that you managed to take some time out of your busy schedules to come and have a discussion with us. So thank you so much. Thank you to IPSAS for organizing such an event. So without wasting my time, please just give me a moment so that I say my go. Please confirm if just confirm before we get started.
Just a commentary there that you can't be heard clearly.
Okay. A moment. Is there any improvement?
Just cross-checking again. I think everything should be fine.
Okay,
Yes,
yeah.
I think you can go ahead.
Now. All right. Thank you so much. Okay, so welcome everyone. So we are focusing on IPSAS 47, and the key focus areas is for us to understand what binding arrangements are and what compliance obligations are, and the two accounting models. Some they prefer to call them accounting models. I also prefer to say, okay, two tracks of accounting for revenue using IPSAS 47, and the accounting for that revenue or revenue recognition using those two models. That's what we'll be looking at. We also have got some examples which we'll also look at. So this is the objective for the webinar. We introduced the IPSAS 47, the revolution, and the introduction of the standard. We expect to spend something like 10 minutes, and we move on to introduce the two track framework, the two accounting models, and we expect to spend 5 minutes, and we move on to delve deeper into the track one model and the track two accounting model, which we expect to spend something like 40 minutes for the two. We also have spent some time for the, we've also spent some time for the case study. So we expect to spend something like 30 minutes. Okay. All right. I can see someone is saying sound quite well. So that I away with audio. Should be better now.
Okay, now it's way better. Yes.
Okay. Tari, is it better now?
Yes, it's way better. Very loud and very clear. Now.
Okay, I think that should be fine. So maybe for a start, thank you so much for confirming. So for a start, please take note, IPSAS 47 is just one standard, though it has got two tracks of how to account for the revenue, but it's just one standard. And the old route of using IPSAS 23, IPSAS 11, and IPSAS 9, it's all now bunched into one, right? Then this is the IPSAS 47 revolution. We used to have IPSAS 9, IPSAS 11, and IPSAS 23, like Madam Tari has rightfully said. But all of these were withdrawn and they've been replaced by a single standard, which is IPSAS 47. Obviously, there was a reason why this was done. So the critical paragraph for IPSAS revenue is actually the paragraph that withdraws these, because the risk that we have is we still want to go back to using these old standards, even though they've already been withdrawn. So I think it's something that's worth our research and knowledge so that we are aware. Please, let's stick to the new standards. You can't be talking of revenue from exchange transactions at this time. Every revenue accounting should be in line with the new standard. Right. Then there is also some new terminology that we just need to be familiar with before we even get started. So please, can you remove from your vocabulary such language like revenue from exchange transactions and revenue from non-exchange transactions? So at least delete that from your vocabulary, and let's introduce new terms, which is binding arrangements and without binding arrangements. Right. So I'm not going to talk about this, but I just decided to bring this to your awareness. If you are to look at the old terminology that we used to have, IPSAS 9, 11, and 23, and for some, you also had you also have a better understanding of even IFRS 15. So this terminology, they've also been revolutionized, and it's no longer, or in IPSAS 47, we no longer refer to just a customer, but we now talk of even resource providers or even third-party beneficiaries instead of just maybe a customer. And when we talk of contracts, this is the old terminology. In IPSAS 47, we now talk of binding arrangements, which is more than just a contract. So we talk more around this. The old terminology, we used to talk of performance obligations, but now we talk of compliance obligations. Right. So I'm not going to spend much time here, but as we go, you will see why it's important to have this distinction at this point in time. Right. Moving on. Let me just, okay. So let's start with this. It's a quiz, maybe just reflect and type in the chat section. We've got 4 questions. So can you answer the following questions, the questions that are appearing on your screens? The question is it revenue from transactions with the binding arrangements, or is it revenue from transactions without binding arrangements? We have 1, 2, 3, and 4 questions. Please, can you just post in the chat section? So I'm giving you 2 minutes to quickly type in the chat section. Yeah, I'm still waiting for some who haven't responded. I'm seeing, yeah, some have already responded. Just a minute to go. While some of you are still typing, okay, let's continue. I think please continue to type and post your responses in the chat section. But for me, allow me to progress. We move on to the next slide. Then we explain, we understand a few things, then we come back to the quiz. Right, so let's now get to understand what a binding arrangement is, because the question here was saying, is it revenue from transactions with binding arrangements or a revenue transaction without binding arrangements? So let's look at what is the binding arrangement before we come back to the same quiz. So when we talk of a binding arrangement, we are talking of an arrangement that confers both rights and obligations enforceable through legal or equivalent means on the parties to the agreement. So we have got two or more parties to the agreement or to the arrangement, and we must actually have, or we must actually be seeing a conferment of rights and obligations to both of these parties, and those rights and obligations should actually be enforceable, right? But there is a reason why IPSAS 47 now introduced the binding arrangement idea, and it moved away from the contract. Remember, when we look at the old standards, or even when we look at IPSAS 15, they all talked or spoke about a contract. And a contract is something that I can actually say it's a subset that is found within a binding arrangement. So a binding arrangement is simply an agreement, which can be an understanding, and in some forms, it can be a contract or a memorandum, right? It can actually be even a law, a legislation, or a policy, or any other mechanisms that can bring two or more parties together. So it doesn't necessarily have to be a contract, but it can be any form of an arrangement that can bring parties together. That's an arrangement. So let's look at, so if we are to say this is revenue from a transaction with a binding arrangement, it means it has to satisfy this first definition. But if it is revenue from a transaction without, it has to fail this definition, right? So if it fails that definition, then it goes the second part of the definition. And the key part to the first definition is the end. To say we must actually be seeing enforceable rights and obligations to both parties. So both parties must actually be seeing rights and obligations from that arrangement. Right, but one of the most important words here is enforceability. So when we talk of enforceability, it's sometimes it's possible to actually have rights, but when you have those rights, they need to be assessed if they are actually enforceable legally, right? So enforceability, let's expound further on this. Enforceability, it makes the arrangement binding. For it to be binding, it has to be enforceable. And it holds the parties involved accountable. And it is based on ability and not probability. By this, it simply means the power must actually exist, right? The power to hold the other party accountable must actually be in existence, and the legal rights to do that should be actually existing. Otherwise, if they do not exist, then it's not enforceable. And the likelihood of that happening is something that it doesn't matter. The probability, the likelihood, it doesn't matter, or even a chance of action to say, okay, the reason why I'm talking about this is because it will also help us when we go back to the quiz. So it's something that we just need to pay special attention to. Then expounding further on the enforceability, we are simply saying, okay, it can also arise from various mechanisms and should be determined by assessing all the relevant factors. And enforceability, it is created or it arises from legal or equivalent means. And when we look at the setup for public sector, equivalent means can simply means any other mechanisms other than just a court action or other than just a legislation, a piece of legislation. So we can even talk of ministerial powers or ministerial directives, treasury circulars. All those are some of the examples of the equivalent means which can actually give an arrangement power for it to be really enforceable, right? And for it to be enforceable, it actually compels completion of the unfulfilled obligations. The parties can hold each other accountable and they can actually compel each party or another party to perform. And it can actually impose consequences for non-performance. Right. Having said that, let's now look at this as an example. Right. So this is the two-track accounting for our revenue. The first question that we need to ask each time we see a transaction, we ask, is it a revenue transaction? Let's identify the revenue transaction. After identifying the revenue transaction, the next question is, okay, yes, there is a revenue transaction, but does a binding arrangement exist? How do we prove a binding arrangement? We prove a binding arrangement by coming back to this same definition that we talked about. So where we said we need to see the conferment of rights and obligations which are enforceable on both parties. So here, if we say answer this question, does a binding arrangement exist? And we say, yes, it exists. Then it means we use the track 2 model. Remember, I said we have got two accounting models, track 1 and track 2. So the track 2 is the revenue with the binding arrangements. But if it's a no, if we ask a question to say, does a binding arrangement exist, and we say no, then it means it's going the track 1. But if it goes the track 1, then it's the without binding arrangements. As simple as that. So even when you are to classify your revenue in your records, it means you also need to follow this because according to the ZFRM, you really need to split between your revenue from binding arrangements and your revenue from transactions without binding arrangements. Right. So both of these tracks, they are actually found in IPSAS 47. And the key issue is the existence of binding arrangements. It distinguishes between these two accounting models. Right. Now, let's go back to the quiz. Let's talk about the quiz. Right. So the first one, it's saying council requires that building owners pay for inspection fees for the various construction stages. Right. So on this one, let's see the responses that we do have. Question 1. I'm seeing binding with binding, with non-binding. Okay, without binding. Yeah. It looks like the responses that that I'm actually seeing here, they're actually different. Some they are saying, some they are saying it's without binding. So it's really important for us to look at this in detail. Right. So when we say it's with binding, it means we need to see both rights and obligations. And when we say it's without binding, it means there might be some rights, but probably there might not be some obligations. Right. With that in mind, let's look at question 1. If a council requires that building owners pay for inspection fees for the various construction stages, what we need to do is we need to come here on this two-track framework slide. Right. Can you just maybe let me use a pointer? Right. For the two parties that we may have, I said entity A and entity B there, or maybe it's a resident as an example. We need to use this diagram to make that assessment to say for entity A, do they have rights? Do they have obligations? And for entity B, do they have rights and do they have obligations? So if we tick all these boxes, all 4 of them, it means it's with a binding arrangement. But the moment it fails any of these, then it means it's without binding arrangement. So it's quite interesting, but this is just a formula that you can actually use to test whether it's with binding or without binding. So for entity A, we need to see both rights and obligations. For entity B, we need to see both rights and obligations. But for it to be without, we can actually see rights for entity A, but no obligations for entity B. Right. Having said that, let's now come back to our question 1 and say, okay, is it with binding or is it without binding? I think it's now quite straightforward. It's now quite straightforward. Right. So this one, it's if we are to test, let's see what are the rights for entity A, and in this case, our entity A is actually the council. And what are the obligations for the council? And what are the rights for the property owners? And what are the obligations for the property owners? So if we are to look at this, you can actually see that we have got, as for the council, as our entity A, they've got a right to receive payment, but they also have an obligation to offer inspection services. So are you seeing there is equal value or almost equivalent value, the service that they are offering and the charges that they are charging, the inspection fees? That's for the council. And for the property owners, they have a right to receive the inspection services. Once they pay, they need to receive the inspection services. But they also have got an obligation to pay those fees, right? Because they can't receive inspection services without paying. So because of that, it actually means that we have ticked all the boxes. And because we have ticked all the boxes, then it means it goes with binding. That would be the correct classification there. Then let's talk about the council receives devolution funds. It's another interesting one. Sorry. Right. So for the council receives devolution fund, this one is a tricky one and it's an interesting one. So some may want to argue to say, okay, as for the council, they've got a right to receive devolution funds from Treasury. And some, they may say, okay, they have an obligation to use the devolution funds, say, for development in their respective jurisdictions. Right. Maybe let's see the responses on question 2, non-binding. Okay, without binding. Okay, yeah, I think majority they are going without binding. Let's see if we have a binding on 2. Majority they are saying without binding. Okay. So yeah, I can see someone gave a reason to say it's without binding because council cannot enforce. But the tricky part is, do you realize that this is constitutional? Why can you? How can you say council cannot enforce when it is constitutional? Those are just arguments, right? To and against. But the overarching issue or the main issue there is, okay, even though it's constitutional, but we come back to enforceability because we said enforceability is based on practical ability and not probability, right? Remember what the constitution does and what the parliament does is just to approve the budget, right? So it's part of their function to approve the budget, and the treasury has got that responsibility to disburse funds, right? Once those treasury releases have been approved, it's also up to the treasury or say Minister of Finance to also they also have got a role to play, which is also a legal role to oversee the finances. So approval for devolution funds to be dispersed vis-a-vis the availability of cash, it's a problem area where Treasury can act legally to control or to prioritize where do we need to put money first, right? So, and that function is a function that they also have been given by legal means, which means if these two, the council and treasury, were to go to court over this, there is uncertainty on the outcome. Because of that lack of the uncertainty, it will mean that it's not, we can't say we are so sure that council will win for them to enforce that they will receive. So based on that reasoning, yeah, this one will most likely go the without binding route, which majority of you managed to get. But yeah, I think majority of you, not a single person said it's with binding. Then as for ZIMRA, charges and collects corporate tax, this one is also an interesting one, but what is the right and what is the obligation for ZIMRA? ZIMRA has got a right to collect corporate tax from corporates, but do they have any obligation in relation to that? You'd realize they do not have any obligation, right? The moment they collect tax, they do not have anything that they need to do in return. Remember, whatever the right and the obligation, right? They must be inseparable. There must be a link, right? So I've seen majority of you also got that one correctly, except a few. Then lastly, the question 4, ZESA charges residents electricity charges which are based on monthly consumption, the postpaid. So as for the postpaid, we just need to test the rights for ZESA, which is to receive payment, and their obligation to deliver or make available electricity. But as for the residents, they've got an obligation to pay, but they've got a right to also receive service, electricity, as soon as they pay or once they've paid. So this is just a few examples to illustrate how you can apply and prove whether something is a binding arrangement or it's without binding arrangement revenue. So this will be quite critical as we then look at some of the examples that we are going to look at later on. Right, having said that, let's now go back to the two-track models. So the two-track framework, we've looked at this, but let's now focus on the track one. The track one revenue model. So as for the track one model, we said we are starting at, let's identify the revenue transaction. Does the revenue transaction arise from a binding arrangement? If no, then it's track one, right? I'm not going to focus much on the accounting for the track one because we've got examples to illustrate that. But the end result is everything will be revenue. It has to come and fit into our revenue figure in our financial statements. But what differs is the classifications. This one is classified as without binding, and this one is classified as with binding. So let's let's talk about the recognition principle for track one revenue without binding arrangements. Right. So when there is in most cases what happens is organizations, they receive resources. Let's take for example, Zimra receives cash. Someone is paying for their tax obligations and Zimra receives cash, right? So the moment Zimra receives that cash, or the moment an entity receives a cash resources, or even if it is not cash resources, sometimes it could be another asset, which is not cash. What they need to do is they need to recognize that revenue, that cash as revenue, only if there is no obligation in return. Like let's take for example Zimra, the moment they receive the tax, they look at, okay, for this cash that we have received, do we have any obligation that we need to fulfill? The moment they say no, then they need to recognize revenue immediately, which is this para 29B. But the moment they receive resources and there is an obligation, for example, let's take a local authority, right? They receive payment, probably it's let's say 20,000, they receive 20,000 from a certain resident. They look at, okay, what is the reason that we receive this 20,000? Do we have any obligation? They look at that, they make an assessment, they say, okay, yes, this 20,000 is for what? For a stand. So they can't recognize revenue when they have not satisfied the compliance obligation to deliver the stand. So they need to deliver the stand for them to recognize the revenue, right? Then it can also happen that you can actually have some grants which are conditional. let's say Treasury can release a grant or which has got some conditions, right? So they can actually say, we've given you this grant so that you use it for construction of roads in your area, right? The moment a local authority receives that grant from Treasury, they ask themselves, do we have any obligation in relation to this? Yes, they have got an obligation to construct some roads. So the moment they have got that obligation to construct roads, it means they can't recognize revenue immediately, but they can only recognize it as revenue when they satisfy the compliance obligation. So they would then have to recognize revenue based on the stages. If they have used, say, 20% of the funds, then the 20% that has been used to construct the roads would need to be recognized as revenue. Right. Let's look at an example applying the track one. So we've got three examples, three scenarios that we do have. Right. The first scenario, it's an unconditional donation. This is to demonstrate the para 29B, which says we need to recognize the revenue immediately. So we have got Rare Children's Hospital that receives medical equipment worth 80,000 from a mining company. There are no restrictions and there is no refund clause and no performance requirement. Right. So remember, we said we need to ask ourselves, is it revenue? Yes, it's revenue. Is it arising from a transaction with binding arrangement or without binding arrangement? How we test the binding arrangement formula, we need to see rights and obligations for both parties, right? And we see, okay, there are rights or there might be rights for another party or obligations on another party, but not rights and obligations for both parties. Why? Because the funding does not have any restrictions and no refund clauses and no performance requirements. Because there are no performance requirements, it means there are no compliance obligations here. Right. So does a present obligation exist? A very important question. When we talk of a present obligation, we have already come out of IPSAS 47 and we've jumped into IPSAS 19, right? That's the standard that it deals with present obligations. So a present obligation, it needs to be tested based on the criteria for liabilities or for provisions, because it's only a liability or a provision that can be a present obligation. So does Rare Children's Hospital have a present obligation? This present obligation is in the form of maybe a repayment if they don't utilize the funds in a specified manner. So based on the case that we just read out there, there is nothing. They do not have any present obligation, right? So what that means is for them to earn the revenue, they don't have to do anything. But if they had something that which they needed to do before they can earn the revenue, then that would mean they won't recognize the revenue immediately. So the rule is when there is no present obligation that exists, then the asset, which is the cash resource, and the revenue, they must be recognized immediately, and there is no liability at that stage. So this is how the journal would look like, because they received equipment worth 80,000. They debit the equipment with 80,000 and they credit the revenue from donated assets with 80,000. As simple as that, that's the 29B, where there are no obligations or present obligations. And the statement of financial position would have a medical equipment asset and surplus. Remember our accounting equation. So we have got assets that have increased, and we also have got our equity that have increased because of the surplus in revenue from the 80,000. Right. That's example 1. Let's now look at example 2. Right. Using example 2, Ministry of Agriculture receives 500,000 from a bilateral donor for rural irrigation schemes. Right. We have got conditions, which is condition number 1. Funds should be spent only on irrigation infrastructure. And number 2, unspent or misused funds must be retained. And the question now is, how do they account for this revenue? Right. So take note. This is the most interesting thing. Remember the previous question we had said, okay, does a present obligation exist? And we said no. And we said, okay, let's recognize revenue immediately. But for this one now, because there are conditions which need to be met before the revenue can be recognized. So the condition number 1, the funds should be spent on irrigation infrastructure. The funds have not been spent as of now. So because they have not been spent, it means it's actually a liability to return the funds if we don't use them on the specified project. Then condition number 2, any unspent or misused funds must be retained. So if they don't spend the funds, maybe within the stipulated time, or if they misuse any funds, then they need to return those funds. Fund the funds from any other sources to return it. So the refund clause, it actually creates an enforceable obligation, right? To either spend the money correctly or return it. So someone might want to think, okay, because there is now an enforceable obligation to return the funds, then it goes the binding arrangement. Because if you test on the binding arrangement, remember I said we want to see the rights and the obligations for each party. So in this case, someone would want to say, so the rights for the ministry is to receive the 500,000. But my question would be, after receiving the 500,000, right? Or they've already received it. What are their obligations? And those obligations, for it to be binding, there must be compliance obligations, which is to say, the money that they have received, the 500,000, right? We must have specified outcomes to say, okay, because you have received 500,000, there is also a service or a good that you need to give in return for the 500 that you have received, for it to be the with binding. That's why it's really important for you to look at, so is there a specified outcome that is a measurable outcome of almost equal value to the 500,000? But in this case, they just received the 500,000 and there is no specified outcome. They just said irrigation infrastructure, but is it measurable? Right? It's not. So take note. For track 1 revenue, we test the liability using the present obligation approach. But for the binding arrangement, which we will talk about later on, we use the compliance obligation test, right? And the key question here is simply to say, is the recipient promising to transfer goods or services to the resource provider, right? Or is the recipient merely required to use the money in a particular way? So in this case, the recipient, Ministry of Agriculture, is simply being required to use the money in a particular way, and they are not really promising, they are not promising to deliver any good or any service, right? Which is measurable. So here, is the existence of a present obligation, which we are simply testing, and we said yes, rather than a compliance obligation, right? So IPSAS 19, it deals with liabilities or provisions. And the question is, do we owe something here? Yes, we owe something. We've been given 500,000 and we have not utilized it, the 500,000 in the specified manner. So because of that, we have got a provision or a liability actually as a result of a past event as receiving. So this creates a present obligation. Yet when we talk of IPSAS 47, IPSAS 47 is simply saying does the worry about IPSAS 47 is revenue recognition. It's not about the liability. We are worried about revenue recognition. So because we are worried about revenue recognition, the question is, have we promised something before we earn the revenue? I hope you understand the framing of the questions on the track 1 and the track 2. Because for the track 1, we said, okay, the risk is we can recognize revenue, yet we still have got an obligation, which is a present obligation to return the funds, right? But for the track 2, we are simply saying, okay, can we recognize the revenue? If we promised something for us to earn revenue and recognize it. Okay. So if we received something, but we have promised something in return, right? Then it will create what most of you know as deferred revenue. And it then creates a binding arrangement obligation, which is a compliance obligation. Maybe to play around with this same case study to illustrate what I'm talking about, let's think of the same Ministry of Agriculture receiving 500,000, and the agreement which they signed, it actually clearly states that the ministry shall construct 20 irrigation schemes in specified districts, let's say in Mashonaland province, right? In 1, 2, 3, 4, 5 districts, as an example, and by such date, say by 2027, right? And they must provide quarterly progress reports to the donor, the bilateral donor. So using this new case study or the revamped case study, are you seeing that if the ministry fails to satisfy those promised compliance obligations, they promised to construct 20 irrigation schemes, which is a measurable output that they promised. So the interesting thing about IPSAS 47 is it's not really like IFRS 15 where the relationship is between an entity and the customer. But here you can actually have a third-party beneficiary. So the donor, we have got the donor and the ministry, but who is benefiting is the agricultural community within, say, the Mashonaland province. So because of that, we simply say, okay, what is it that the ministry has promised? It's not only spending money. They have not promised to spend money like this example that was here that we used. But they have actually promised to deliver a specific measurable outcome, which is the construction of what? 20 agricultural or 20 irrigation schemes, right? And this is what the ministry needs to deliver, which is an output. So because of that, it will have to go the binding arrangement route, this one, because we can clearly see the donor's rights, which is to receive the promised irrigation infrastructure outputs and the reports. And also the ministry's obligation is to construct the irrigation schemes, which is something that's measurable, not just to spend money, because just spending money is something that is not of almost equivalent value to the money they have received, right? And this one, the example that I just gave, the updated example, is actually enforceable, right? It's actually enforceable because we said, okay, they have to construct 20 irrigation schemes, and if they don't construct the 20 irrigation schemes, which is something that's measurable, the donor can come and say, okay, we agreed that you need to construct 20, but you have only constructed 15. They demand or enforce. Remember, we said enforceability. It compels the other party to perform, right? And they can actually take them to court to enforce that. They ensure that, okay, the 20 schemes are fully constructed. So let's pause it there. We'll look at a detailed example on that, but I just wanted to demonstrate that the difference between a present obligation and a compliance obligation. So even though there are conditions to this revenue line item, these conditions, they are not there are no promises. They are not promising, the ministry is not promising to provide a measurable output, which makes it difficult to be a binding arrangement. So it's still fake one, and there is no binding arrangement obligation in terms of IPSAS 47, right? Nothing is being exchanged here. So it still, it goes the liability route. So how is the accounting? The accounting that needs to be done then is the moment they receive cash, assume they received cash on 1 March, then they have to debit the cash, 500,000, and they credit the grant conditions liability. Right, take notes. You will see a different term later on. This one, we are saying it's a grant condition liability, which is a liability arising from this present obligation. This one that once talked about. So it's just a normal liability. Then March to June, they spend 180 on irrigation works. So what do? They debit the grant condition. They now reversing the liability of 500 with the amount they have spent. So they reverse that liability because they have satisfied to the tune of 180 and they recognize revenue of 180. Remember, it's now different from the previous one. If you look at the previous one, the revenue was recognized immediately. Everything was recognized immediately. But this one, because there were some conditions which needed to be satisfied, it goes the liability, which I call the grant conditions liability, but it's a normal liability that we know. The other additional entry would be the recognition of the infrastructure. Some we put it in the work in progress because probably it's not yet complete, still during the year. Then at half-year reporting, they've got revenue of 180, a liability of 320, which is the 500 minus a liability of 180 that we reversed. Then we still have cash of 320 sitting in our books because we have spent 180 on the irrigation equipment. Then at year end, assuming year end is 31 December, they have now spent a total of 470,000 and 30,000 is unspent, but the project is now complete. What happens? They now have to reverse a grant conditions liability of 290, the additional 290 because they have spent already 180. For them to come to 470, it means we are simply saying, okay, 500 minus 180 minus, or rather it's 500 minus, okay, sorry, just let me take that one again. So at year end, we are simply saying they have already reversed a grant conditions liability of 180. So from 180 to 470, which they have now spent in total, what's the difference? 470 minus 180, we get our 290, which is the grant conditions liability from June to year end. And we recognize revenue, the additional revenue for the additional funds that we just spent. And recognition of the equipment, I think let me pause this, but the most interesting one would be this one, the 30,000 that is unspent. I think that's one of the most interesting things to say, okay, because it was still sitting in the grant conditions liability, we had not recognized it as revenue. It's easy for us to then reverse it and it goes back. We refund it back to the donor because the donor said if there are any unspent funds, they must be retained. So what it simply means is the 30,000 is not yet spent and the project is complete, so we need to retain it. It's not our revenue. But the moment you would have recognized the 500,000 as revenue initially, when you have not yet satisfied these conditions, it will be difficult for you because with the revenue account, you can't be playing around with the revenue account. You post things, you remove them, you post them, you remove them. That will be a tricky one. So the final position is we now have revenue 470, which is the 180 plus the 290, these ones. That's our total revenue, but we no longer have any liability because we have extinguished the liability by performing. We've now performed the present obligation that we had. We no longer have any present obligation because we had to retain any unused funds, but we have retained it and did it. So the cash that we have retained is 30,000, and we now have an asset of 470,000, which is the irrigation equipment that we just constructed. So that's scenario B, conditional donation, right? The first one, remember, it was no conditions, right? That was the first one, unconditional donation. The second one, conditional donation. Let's now look at the third one. Right, so the third one, it's a pledge. So it's a donation receivable before cash arrives. So we have got Bulawayo City Council, which receives a signed pledge of 120,000 from an international donor on 15 November 2025 for a community park. There are no conditions, and cash was then received in January 2026. But a promise came 15 November and year end is 31 December. So how is this revenue accounted for? So interesting. The key question is, can the council recognize revenue in November before cash arrives? Right. I think it's how this case has been structured. In most cases, because it might lack enforceability. If someone promises to give you something, you can't enforce because it's just a promise, right? Like those pledges that we normally make at church, right? No one can take you to court for then not honoring that. I know you feel guilty for not fulfilling, right? But for this one, we are simply saying, okay, it's a signed pledge. Because it's a signed pledge, it means it's enforceable. So what that means is there is a right to receive the 120 from the international donor. They can actually enforce. You said you give us this much. So can you please transfer the 120,000, right? Which is Bulawayo City Council's right. But do they have any obligation? They do not have any obligation because there is no immeasurable output, right? They did not promise anything to the donor to say, this is what we will do. Remember the concept of promises, right? You should have promised something to a customer based on IFRS 15, but here it's a promise to the resource provider and the beneficiary. So in this case, there are no obligations, right? Because it failed obligations, but are you seeing that testing using the binding arrangement formula where we said we need rights and obligations for both parties, right? We have got entity A, we have got entity B. Do they have rights and do they have obligations? So we are simply saying, okay, for entity A, which is Blawayo City Council, do they have a right? Yes, they have a right. But do they have an obligation? They do not have. Already, yeah, it has failed the binding arrangement test. Then for the donor, international donor, do they have a right? They do not have any right because they just said, okay, we are going to give you, but how they are going to use the funds, right? They don't have any rights pertaining to that to say, okay, you should have done it this way. You should have, constructed the community park in this manner, but they have an obligation because there is a signed pledge. They've got an obligation to transfer. So because it failed parts of what the binding arrangement, then it automatically it goes the without binding arrangement route. So because it has gone the without binding arrangement route, now the key question is, can they recognize revenue? How should they recognize revenue? We are clear that it's without binding, but how should they recognize the revenue? So there are three things which are critical, which needs to be satisfied for them to recognize the revenue immediately, right? So enforceability, there is a signed pledge. Remember, they haven't received the cash, but it's a promise. So is that promise enforceable? Yes, it's enforceable, right? The signed pledge makes it legally enforceable, right? And do we know the amount that we are going to receive? Yes, explicitly stated the 120 there, right? How about the probability of us getting the 120? Because for a cash resource or a receivable resource, right, you need to establish that it's highly probable that you are going to receive it. So this one is an international donor and it's highly probable, right? Probably based on past practice, highly probable that they're going to receive it. Even them committing to sign, it means it's something that they are willing to fulfill, right? So what then happens? On 15 November, the donation is recorded as a receivable, which is like just like a data. And on the same date, revenue is recognized for 120. Then in January, it's no longer revenue, but it's just now a cash receipt. So they debit the cash 120, which they received, and they credit the receivable. They now reverse this receivable. As simple as that, that's how they account for the revenue. So there is no revenue in January because it had already been fully recognized in November. The reason is there were no conditions which needed to be satisfied for them to recognize it as revenue. So take note, if a pledge is a verbal or it's unenforceable, then there is no asset that exists. We do not have cash resource and we do not have a donation receivable, right? But what Blawayo City Council can then do, if that was the case, is they just disclose probably a contingent asset in their notes, in their disclosure notes, and they can only recognize it when cash has been received or a legal right has been confirmed. Like in this case, there is a signed pledge, right? And number two, if, for example, a pledge is withdrawn, like this one, though it was a signed pledge, but if the international donor then later withdraws, then they also need to reverse the revenue, right? So it depends. If it is a reversal, right? They can actually say, okay, debit, revenue, credit, donation, receivable. However, sometimes they may not reverse as donors, but they can just go quiet, and it will be difficult to recover it, right? What can happen is if it is irrecoverable, then it simply means it needs to be treated through the normal impairment route for receivables, right? Rather than a revenue reversal. But this one, because it wasn't a reversal of a pledge or cancellation or withdrawal of a pledge, but it was actually a standing pledge that we still expected, but we've seen that, okay, it's now likely irrecoverable, right? And one of the most common errors that can happen is some entities can wait until January to recognize revenue, and we have some challenges with auditors because you want to receive the cash first in January, and you say so it's revenue for January. Yet conditions that prove that it's actually your revenue it happened in November of the previous year. And some they recognize, which is also in error, some they recognize a receivable, right? A verbal receivable before they can actually prove that it's actually enforceable, right? So this can result in overstatement of your donation receivable assets, and even your revenue. You would have recognized your revenue prematurely. So I think it's one of the frequent findings, especially in local authorities, right? I think that's without binding arrangements. Then, having looked at the track one without binding arrangements, let's proceed and now look at the track two, where we look at revenue from transactions with binding arrangements. Right. So this one is quite simple and straightforward. Majority of you may have come across this if you have done IFRS 15. But for those who haven't done IFRS 15, I think that's the reason why we are here. Right. So the track two, which is the with binding arrangement. Right. This one, it follows the same nature, the IFRS 15 approach of using the 5-step model. So we've got 5 steps that we do have here. And instead of it being called the 5-step model, the IPSAS team just decided to call it the binding arrangement model. So we account for revenue from transactions with the binding arrangements using the binding arrangement model. Right. But we can all see that this was adapted from IFRS 15. And the most important step that we want to also focus on is the last step, revenue recognition. Because the question is, okay, how do we recognize revenue? Right. So I think we are happy now with accounting for revenue from transactions without binding arrangements. So let's now look at how to account for revenue from transactions with binding arrangements. We have got step number 1, identifying the binding arrangement. Step number 2, so maybe in contrast, in IFRS 15 or in the previous standard, this was identify the contract. So instead of a contract, it's now a binding arrangement. And here, instead of identifying performance obligations, it's now identifying compliance obligations. which those promises to deliver distinct goods or services. Then determining the transaction consideration instead of the transaction price that we used to from IFRS 15, and allocate to each compliance obligation. So it's allocation to compliance obligations, which are at step number 2 there, right? And not performance obligations. Performance obligation is kind of limited. Then recognize revenue when each compliance obligation has been satisfied. Right, those are the 5 steps, which are more or less the same with IFRS 15. So let's talk about identifying the binding arrangement. The binding arrangement, we have already identified it. We've already talked about it. I think you can recall this diagram here that I've just cycled out. So for it to be a revenue with the binding arrangements, it must have satisfied this diagram, the binding arrangement formula. Do we have rights for entity A, and do we have obligations for entity A? Do we have rights for entity B? Do we have obligations for entity B? Then it's a binding arrangement. But over and above this, you need to come and prove the 5 conditions from para 56 that, okay, all of these, they are actually satisfied, which is parties approve the arrangement. So there must be a way to prove that parties have approved the arrangement, which can be either written, it can also be verbal, or it can be implied, just like a contract. A contract can be even a verbal one, or an implied contract, or an explicit contract. So the same also applies, right? But take note here, we are talking of the binding arrangement, which we said, okay, binding arrangements can take the nature of any arrangement, even including the ministerial directives. Are they binding in any way, right? Then rights are identifiable, each party's rights. This is the same process that we would have done here, because we are seeing each party's rights here. So because of that, it would have satisfied the rights. And payment terms, which links the amount, the timing, and the method of payment. Can it be identified from the arrangement? Is there any amount, and is there any timing on how the amount is going to be paid? Is there any method that is being used for the amount to be settled? Then commercial substance, the transaction is genuine economic reality, right? So this is just an economic value, right? Which can be either positive or negative, but there is economic value in it, right? It doesn't mean it has to be positive always. Then collection is probable, which is, okay, how likely is it for collection? And this can be linked to the payment terms. The terms that we see on the payment terms can actually tell whether it's probable. Take note, if it satisfies all these 5 conditions, then it has satisfied the binding arrangement, and we account for it using the binding arrangement model. But if it fails any of these, then it means automatically it goes back to the without binding arrangements. There should have been somewhere where you would have not looked at correctly, right? Then step two is an issue of identifying the compliance obligations. Remember my previous comments on distinguishing between a present obligation and a compliance obligation, right? So a compliance obligation is actually a promise of a measurable output to say, okay, what are the outcomes that the entity would have promised to its resource provider or to its beneficiaries, right? So let's take, for example, we can have the Registrar General's office, right? They promised passports, right? So they charge a passport fee
and they have to issue a passport, which is a single compliance obligation. If a beneficiary comes to the Registrar General's office, they can just say, okay, I want a passport. They are required to pay, which is their obligation, and the Registrar General is a right to receive payment. But the obligation is to issue a passport, and this one has got a right to receive the passport. And in terms of economic value, we all know that, okay, for a passport, a 1-day passport, a 3-day passport, or a 2 weeks passport, how much they charge, right? Then, for example, as another additional example, you can have use it offering tuition and some exams, right? So you pay a certain amount, and for that amount, we might need to separate between, okay, what's going for the tuition, what's going for the exams, right? But before we separate, the key question is, are these two separate promises? Yes, they are two separate promises. Can we make an assessment on whether the two separate promises are two compliance obligations or they are one compliance obligation, right? So for us to assess that, we use these two. Is it capable of being distinct? Is it capable, is it possible for user to offer tuition separately, right? And can the beneficiaries benefit from the tuition services separately, right, without any other promises? Yes, it's possible. Can the beneficiaries also benefit from the exams even without the tuition? Yes, you can access the exams, right? It's still possible. Then you look at it from the context of the contract, what's their intention. The promise is separately identifiable, right? So are you able to separate the two? Isn't the intention to integrate the two promises, right? Depending with the circumstances, you can actually come up with two distinct compliance obligations, which is the lectures and the examinations. And what it means is on your step number 4, right? Allocation, you may need to allocate to the two compliance obligations that you would have had. Right, there, that's step number 2. Then step number 3, determine transaction consideration. And transaction consideration, we may have a fixed amount or variable amount or constrained variable, depending with the circumstances. Using the use it example, it can be said, okay, we have got 1,000 students and each student is paying 2.4 per annum, right? Or 1.2 per semester. So it's actually a fixed consideration, right? Right. As for the variable consideration, this one is very common, especially I've taken note. I've just seen a comment, someone asking for the slides, right? As for the variable consideration, this is very common, especially in the construction industries or for organizations that have got something that they are constructing. Right? Then okay, it depends. Someone is saying for use it, I don't think there is a distinction. So it depends with the facts and circumstances, right? There are some examinations that people receive even from academic institutions, which they can actually, okay, like let's take for instance, if the arrangement is like that of ACCA, we can actually go to and you write an examination on demand where you received your tuition, they don't mind. So it depends with the arrangement, right? And their intention, if it's to separate or if it's not to separate. Then as for the constrained variable, right? So these constrained variable amounts, they may only be included if highly probable, right? And there is no chances for reversing because we don't want to play around with our revenue account, right? So what's important is you need to always apply the constraint before including the variable amounts. You need to apply, right? Let's test if it is highly likely that we are going to receive. But over and above all these forms of consideration, these are all cash consideration. It's also possible that you can actually have non-cash consideration. For example, if you remember the first example, scenario A that we looked at when we were looking at the track one accounting model, where you saw a donated asset for 80,000. Right, so it's an asset, but sometimes you may not even have the value. You have been just received. You have just received an asset, right? And if you do not have its value, it means you may have to estimate its fair value, because for non-cash consideration, it is to be accounted for at fair value. Right. Then step number 4, allocation to each compliance obligation. Example. Right. Let's take the EMA license and assume all these 3 processes that we have are separate compliance obligations. So for you to separate and say, okay, these promises are separate compliance obligations, you separate using step 2. Right. Can the customer benefit, or can the beneficiary benefit from it on itself, each stage on itself, or can they actually, is it separately identifiable in the context of that arrangement? Is it possible that they can actually separate? So let's assume they've separated these. So just to demonstrate how to allocate using the standalone selling prices, the price is actually 1.5 here, but the standalone selling prices for each process, if you were to go for the application review alone, they charge 300. If it's for site inspection, it's 500. If it's for license issuance, it's 400. So you can just use this as a percentage, 300 divided by 1.2 multiplied by the new price of 1.5. So it's 3 over 12, 300 over 12, or 1200 times 1.5, you get 375. You do the same for the site inspection. So this is how you are allocating the 500,000, which is the price that we've been given, or the consideration that we've been given for all the steps in issuing a license. But if there is only one compliance obligation, you can allocate where you have got more than one compliance obligations. Where you have got one compliance obligation, there is no need for allocation, because all the consideration is going for that one compliance obligation. Right. Then step number 5, recognition, revenue recognized over time criteria and at a point in time criteria. Right. So for revenue recognition, you always have to test the overtime criteria first, where any one of these needs to be satisfied. If we say, okay, the first one, resource provider simultaneously receives and consumes benefits. As an example, can have Harare City Council supplying water every day, and as water flows, the residents consume it, right? And they benefit, right? That benefit that they are receiving as they consume the water as residents, they are benefiting, and that benefit is being consumed immediately the same time they receive it. So if that's the case, then revenue is recognized over time, right? Then even for B, entity creates or enhances an asset controlled by resource provider or beneficiary. This normally happens especially in the construction sector where say government of Zimbabwe has contracted say bitumen weld to build a road or an interchange, right? But that interchange is being controlled by the government of Zimbabwe or by the local authority as it is being constructed. If that's the case, then revenue is recognized using the overtime criteria. And the last one is where an asset is being constructed is of a specialized nature. For example, if it's a passport printing facility, who can do passport printing in Zimbabwe besides the Registrar General's office? So it's highly specialized in that area. Right. So take note, when cash is received before the compliance obligation, we have received the cash before we offer tuition for use it, or we receive cash before we deliver a passport. It is not revenue, right? But we have got a liability. Such a liability is different from the liability that we were talking about previously. Remember the liability that we were talking about previously, it was like a grant conditions liability where we received revenue and we've got promises, not promises rather, but we have got some requirements which we need to follow, right? But that was a liability for without binding track. But a liability for the with binding track, it's called a binding arrangement liability, which is more or less like your contract liability, right? So this binding arrangement liability, it's actually a liability that you need to unwind as you receive or as you perform, rather, not as you receive, but as you perform. For some, you receive from a third party, then it could be a conditional grant with measurable outputs. You receive, you utilize, which is performance, and you recognize revenue. Right, let's look at examples to illustrate this. Right, let's start with the Registrar General's Department, passport fees. Right, we are now applying the full 5-step approach. So scenario is there are 20,000 passport applications that have been received, and each passport is charged 150 USD. Total cash that has been received equals to 3 million. And by year end, only 15,000 passports have been issued. 5,000 are still being processed. So how do we count for this revenue? Right. So take note, it's the issue around the binding arrangement liability that we want to talk about. But let's start from the first step, because we said we are using the binding arrangement model, which is the 5-step model. So let's start with the step 1. Is there a binding arrangement? It has to satisfy all those 5 conditions, right? So the 5 conditions for the passports, let's come back to the, okay, there we go. These are the 5 conditions. So for the passports, is there binding arrangement approval by the parties? Right. Though it may not be written or verbal, but it's implied because that's what the Registrar General does, right? So you going there knowing that this is what they offer, this is the service they offer, right? And you commit to pay, or you actually pay your 150. It means you both understand what you want to do, right? Approval implied. What are the rights and what are the rights for each party? Right to receive a passport, right to receive what? Passport fees. What are the payment terms? It's advance payment, right? The amount is actually 150. The timing, it's actually an advance payment. Method of payment, you can actually pay cash, you can do a bank transfer, etc. Right? Commercial substance. Confirm for the Registrar General's office. This has got economic reality because their cash resources, they've actually increased by 150, right? And collection probability, is it highly probable that they are going to collect? Yes, they can't give you the passport before you actually pay. They don't even process your papers before you pay. So it's highly probable, right? That's as an example, your step number one. Then step number two, uh, what has been promised by Registrar General to the people who have applied for passports. They've promised a valid passport, right? And this one, it's a single promise, right? Which you can assess and conclude that it's a single compliance obligation, right? There are no distinct subtasks like, okay, we need to receive your application, we process it. What they just want, or the resident just want, is a valid passport. So the obligation, the compliance obligation, is the completed passport. Then transaction consideration, fixed amount of 150, right? And per passport, a total of 3 million. Then allocation, because it's a single compliance obligation, no need to allocate the whole amount, is just for the passport. Then step number 5. When do we recognize the revenue from the Registrar General's perspective? Right. So is it over time, or is it at a point in time? So you come back and you test that using this approach. We said we test the overtime criteria. The moment it fails the overtime criteria, automatically it goes the point in time criteria. So over time, maybe for you to understand, this applies to A, B, and C. So is there any simultaneous receiving and consuming of benefits for issuing a passport? It's not like that. Does it create an asset that that is controlled by the resource provider or beneficiary? It's not, right? It's not an asset that that you are controlling. Before they issue it to you, you don't control it. You control it when they pass it on to you. Is it of a specialized nature? No. So it fails the over time, it goes the at a point in time. But we realize sometimes the at a point in time then also applies for goods that can actually be transferred, like physical possession. You can easily transfer a good, something like that. So it's at a point in time, and when passport is physically handed to the applicant. So that's when they satisfy their compliance obligation. They promise the passport, and the moment they transfer the passport to the recipient, that's when they recognize their revenue. So the revenue that they need to recognize is because they've only issued 15,000, they need to recognize revenue to the tune of 15,000, and the binding arrangement liability for the 5,000 that are still outstanding. Okay. So this is illustrated by these entries. So on receipt, the moment they receive the cash, they receive the cash resource 3 million, and they recognize the binding arrangement liability of 3 million because they haven't issued any passport, which means they haven't satisfied any compliance obligation. But the moment they satisfy for the 15,000 passport, when they issue the 15,000, it means they reverse the binding arrangement liability by 15,000 times 150, which is 2.250 million. And they recognize the revenue. It's now revenue for 2.250. And at year end, the balance sheet would have 3,000 because they received the cash resources for 3,000. But they also have a binding arrangement liability for 750,000 for the 5,000 passports which are yet to be issued. And the net position, remember the accounting equation, our capital is equals to assets minus liabilities. So assets of 3,000 minus the 750, it will give us the net assets of 2.250, which will equal the surplus in the equity section, because our revenue would have increased by 2.250, the one we recognize to affect our surplus by 2.250. Right, that's scenario one for passport fees, demonstrating the 5 steps and also demonstrating the at a point in time. Now let's look at University of Zimbabwe annual tuition. And for the annual tuition for the University of Zimbabwe, we have 1,000 students, each pay 2.4 annually, and tuition that is their tuition on 1 January. And the academic year actually starts in February to November, which is 10 months. December, nothing happens. And reporting date, okay, half year reporting date is 30 June. We go the same route again, right? We draw our box or quadrants, right? Rights and obligations. Right. The moment you say, okay, we have ticked all the boxes, we have rights and obligations for each party, because for students, they have got a right to receive tuition and an obligation to pay. For UZ, they've got a right to receive tuition and an obligation to provide services. Right. Having satisfied the binding arrangement, we now need to test the step 1, right? If we go back to test step 1, okay, binding arrangement approval, the parties' rights, payment terms, economic substance, and probability of collection, all those 5 conditions. We test them, which will all be satisfied. Then compliance obligation. So the compliance obligation, what has been promised by UZ has promised to deliver academic programs, right? Depending with the circumstances, I've seen some comments, people made some comments on the UZ example, right? Depending with the circumstances, right? There could be multiple obligations, which is exams and tuition separately. If that is the case, then you can go ahead and split the compliance obligations. You'd have, say, 2 compliance obligations, the tuition and the exams. But for the purpose of this exam, just assume it's a single compliance obligation. Right. Then the consideration, 1,000 students by 2.4. How it's allocated, because we assumed it's a single, we allocate that there is no need for allocation. All the 2.4 million will go towards the single compliance obligation, right, which is academic programs. Then revenue recognition, is it over time or at a point in time? So remember we said we test the overtime criteria. So the overtime criteria, we said, let's test if there is a simultaneous receiving and benefiting, right? Is the beneficiary simultaneously receiving and benefiting, which is normally the case with tuition providers. As the tuition services are being offered, the beneficiary is receiving and is also benefiting immediately. So because of that, you realize it is satisfied the first condition, which is the overtime criteria. So it's our track 2 approach, and it's overtime. Right, so what that means is, as it's 30 June, which is half-year reporting, we have got, that's half of the semester, right? How much revenue should we recognize? It's 5 months, February to June, multiplied by 1.2, which is the semester tuition. and the other 1.2 for the July to November months, it will be a binding arrangement liability, which is illustrated in these entries. Right, we have got January, the month of January, where we received the cash, but no education services have been provided. So the first journal would be debit cash, but credit the binding arrangement liability. Because we haven't offered the tuition, we haven't satisfied our compliance obligation, whatever that USAID has promised to its beneficiaries, they haven't satisfied them. So it's a liability, not revenue, right? But let's go to the month of February. The month of February would say, okay, at end of month, right, for the month of February, it's like, noted. So at the end of February, they say, okay, let's reverse a binding arrangement liability for the portion of the revenue that we had already earned, because we've offered tuition for the full month. So how much is revenue for the month, for each month, right? Okay, let's split 1/10 of the 2.4. That's revenue for 1 month. That's 240,000. So the 240,000, we reverse a liability and we credit our revenue. We now have revenue of 240 for the 1 month. So at the end of each month for the next 9 months, this is the same journal which USAID will need to process, recognizing their revenue. Because revenue is recognized when you have satisfied your compliance obligation. You can't say it's revenue when you haven't satisfied. So over time, as you satisfy, otherwise, per month is just, it's an approach where we don't want to create a lot of work. Otherwise, you'd have said, okay, I've offered tuition for a week, so let's recognize revenue for the week, right? Or I've recognized revenue for each hour, each lecture, right? Each second, but it will make the life easier, the life difficult for the accountants. So because of that, it's just easier to make it every month so that they recognize revenue. So at the end of the year, or is it 30 June rather, half year, we have cash that we have received. We haven't utilized any as used, so we have 2.4 as our current asset. And revenue recognized, we have recognized revenue for 5 months only, which is 1.2, right? So it increases our surplus in the statement of financial performance. Then we also have binding arrangement liability for the remaining 5 months, July to November, which is a current liability, because we haven't satisfied this compliance obligation. Please, when people pay fees, it's not your revenue already. It's only revenue when you have offered the service. So it must actually be sitting in the binding arrangement liability account. Right. Then let's look at the last example. The Ministry of Health, the Global Fund grant. So the Global Fund signed an MOU agreement committing to transfer 20 million on 1 January 2026 to Ministry of Health to procure and distribute malaria medicines to 500 rural clinics by 31 December 2026. The agreement states that funds were eventually received but restricted to this purpose. Unspent or misused funds must be retained. Quarterly reporting is actually required, and failure to comply will result in the suspension of future disbursements of funds and demands for immediate repayment. By year end, 12 million medicines had been distributed to 300 clinics. Right. So how do we account for this revenue? First, we need to say, is it revenue from a transaction with binding arrangement, or is it revenue from a transaction without binding arrangement? So the starting point is that, and we say, okay, let's test using that quadrant, rights and obligations. What are the rights for the global fund, and what are the obligations for the global fund? What are the rights for the Ministry of Health, and what are the obligations for the Ministry of Health? Critical questions. I think that's the problem area for most people, because this one, it seems like it's almost the same with the other example that we once looked at, the one that I then later on twisted, if I remember very well. Or what was it? Was it this one? I can't remember. I think it was this one. Yes. Right. It was this example, Ministry of Agriculture. Right. So remember my explanation. I said you need to distinguish between a present obligation and a compliance obligation where you have promised something. A present obligation, no promise, right? But for a compliance obligation, you would have promised something. So here, we are simply saying, what are the rights for the global fund? They've got a right to require medicines to be distributed to 500 rural clinics. And they've got a right to receive quarterly reports, the updates. They have also a right to demand repayment. Can you pay back any of the unspent or misused funds, right? Are you also seeing that they also have got a right to suspend any future funding? So they've got all these as their rights. But what of if these are their rights, it actually means these are also obligations for the ministry. Then the obligations of the ministry, they need to procure the medicines, and they need to distribute those medicines to 500 rural clinics, right? They also need to submit quarterly reports, and they have to return any unspent or misused funds, right? So if we are to look at the quadrant, the rights and obligations, right? We have seen rights for the global fund. How about their obligation as global fund? They have got an obligation to transfer, because they actually signed in MOU, they have got an obligation to transfer 20 million. And as for the ministry, they have got a right to receive the 20 million. Right. And these rights, they are actually enforceable because there is a refund clause that we've seen there, right? It means it's enforceable, right? And there are also some reporting requirements that we have seen that quarterly reporting is actually required, and they can suspend future funding. These are all ways of enforcing. Enforcing doesn't necessarily mean you have to go to court, but enforcing can also mean that, okay, we can demand you to act in a certain manner, right? We compel you to act. They've got a right to recover any misused funds, right? So let's now look at, now it is satisfied all the quadrants. We are happy it's track 2 binding arrangement. But if it is binding arrangement, we then need to test step 1 all the way to step number 5 using the binding arrangement model. So using the binding arrangement model, we come on a binding arrangement. Is there a binding arrangement? It is to satisfy all the 5 conditions under the binding arrangement, right? Approval, as well as rights, as well as commercial substance, and the last one, probability. And if all those ones are satisfied, then it means for sure it's a binding arrangement. Then as for the compliance obligations, right, what are the compliance obligations that we can actually see? This is the critical part that distinguishes this example to the previous one on Ministry of Agriculture. Why? Because this one, we actually have some measurable outputs, which is to procure and distribute malaria medicines to 500 clinics. It's not merely to receive 20 million like Ministry of Agriculture. Their obligation was just to receive and use, right, the funds. But here it's not just to receive, but it's to receive and at least they must satisfy all the conditions, which is procure, distribute to 500 clinics, rural clinics, right? If they distribute it to a clinic that is not rural, then they would not have satisfied the compliance obligation. So the obligation is the program output and not the funding receipt. It's not just receiving, but the funding, right? So having looked at that, those are the compliance, that's our compliance obligation that we actually have here, right? We need to look at the consideration, which is the fixed 20 million, and allocation. No need to allocate, just use one compliance obligation. Then let's test the overtime or at a point in time. So in this case, the ministry satisfies obligation progressively as medicines are procured and distributed. Right? Are you saying that they receive from the Global Fund? After receiving from the Global Fund, I want you to see that we now have three parties to this relationship. We have got the Global Fund, we have got the ministry, and we have got the rural clinics, which are the beneficiaries. So they have received the funds, but the funds, they need to be used to procure medicines, malaria medicines for 500 clinics in the rural areas. So as they receive the funds, they also progressively acquire the medicine, and they also distribute to the clinics, the rural clinics, which most likely satisfies the A condition and the C condition that we looked at when we were testing the overtime criteria, right? Because of that, it will mean, okay, we recognize the revenue over time. But the key question was 12,000 medicine had been distributed to 300 clinics as at year end. So how will they account for this revenue, right? So we have got 12,000 as revenue because we have already satisfied the compliance obligation, which is to buy and distribute, need to procure and distribute. We have satisfied for the 12,000, so that's our revenue, credit revenue. How about for the remaining 8 million? It's still sitting in the binding arrangement liability because it's unspent. So it's either we have to spend it on the remaining clinics, maybe 200, or we retain the funds, right? So I think this is quite important, this example, because it helps you identify the compliance obligation. It's clear that you can actually identify a measurable output in the form of a good that may need to be transferred to the beneficiaries. So let's now look at, this is how the entries will be like, right? It's a three-party structure where we've got the donor. So the moment they receive cash, 20 million, debit cash resource, credit binding arrangement liability, because the obligation has not been satisfied, the compliance obligation. They haven't satisfied any, and at year end, after satisfying up to the tune of 12 million, they reverse the binding arrangement liability and recognize revenue for the portion they would have satisfied. Right? If every month they satisfied a certain portion, this can be broken down to be a monthly journal. Right? Then at year end, this is how the statement of financial position will look like. They will have a binding arrangement liability of 8 million, and they will have revenue as part of their surplus of 12 million. Right. So I think you must also be clear on the binding arrangement liability and the grant conditions liability, the differences. For the binding arrangement liability, it is a result of a binding arrangement where you actually have some promises and compliance obligations which you need to satisfy before you earn the revenue. But for the grant conditions liability, it's simply a present obligation as a result of past events, and you simply don't have any compliance obligations you need to actually satisfy before you earn the revenue, right? Right. Having done that, I think this is just a summary of everything that we looked at, right? Just covering almost everything as a summary between the track 1 and the track 2 arrangements that we can actually have. Then before we sign off, something very important, or before we go to the question and answer section, right? Remember, auditors are much interested in your accounting work, especially for revenue. Revenue is very important because it forms the bulky figure in the statement of financial performance for most entities, right? And if it's not like that, but you are striving to make sure that you have got the revenue being one of the largest figures in your statement of financial performance. So as auditors, the Office of the Auditor General visits you, number one, they may want to see if you are actually continuing to apply the withdrawn standards instead of applying the new standard. Remember, the new standard it was effective 1 January 2026, but we have been given the 3 years from 2023, May 2023 to 2026 for us to learn the standard and learn how to apply it. So that's why you saw it's earlier adoption was actually recommended. What it means is your 2026 financials, they should not be speaking of IPSAS 9, 11, 23, but they should be speaking of IPSAS 47. You can't be talking of revenue from exchange transactions and revenue from non-exchange transactions. So auditors will have to scan your financials to look at this. So number one is how you classify as per the face of the statement of financial performance. And number two is them visiting the notes to see, is it in line, whatever that is on the face, is it in line with what you presented on the face? Then also, one of the risky areas, some may recognize all cash received as immediate revenue, and they do not recognize a binding arrangement liability or a grant conditions liability. So take note, that's why I had to take some time to go through the distinction between a binding arrangement liability and a grant conditions liability. So what it means is you need to recognize cash as revenue. If you receive cash in advance, you can only recognize it as revenue only when the grant conditions have been satisfied or when the binding arrangement conditions have been satisfied, the compliance obligation. Right. Then when you are applying the track 1 rules, some may risk, the risk here is some may apply the track 2 rules to track 1 transaction. If it is a revenue with binding, someone applies the binding arrangement model, the 5-step for a transaction without binding. But some would say, okay, for a transaction with binding arrangements, they apply the without binding, the track 1 rules. So you also need to watch out for this sometimes it emanates from the fact that you would have made an error in terms of your classification, whether it's binding or without binding. If you make an error there, it means the model that you are going to apply will also be incorrect. Then failure to identify and record compliance obligation, liability, or binding arrangement liabilities. So for some, you would miss, you fail to identify that, okay, the revenue that we have received, there are some conditions attached which can result in a grant conditions or binding arrangements, compliance obligations. So all of that. Then lastly, no accounting policy at all distinguishing track 1 from track 2. Because the moment you say this is, we have got 2 billion ZWG revenue from transactions with binding arrangement, or just say we have 2 billion revenue, but someone is interested, okay, the 2 billion, how is it split between the with binding or without binding, right? So even the ZFRIM recommends that on the face, you actually need to indicate how much is from with binding, how much is from without binding. And you provide some disclosure notes and accounting policies in relation to that, where you provide more detail as to what is it that you are calling with binding, what is it that you are calling without binding, which is something that the auditors will need to dig deeper and find out if we had done it the correct way. So I've proposed an 8-step roadmap where you can follow this process to correct wherever you may need to correct, or understand wherever you need to understand in terms of your accounting models, which all starts from the process of identifying the revenue streams. Do we have a revenue transaction in the first place? If we do have, is there a binding arrangement? If yes, we use track 1. If no, if yes, we use track 2. If no, we use track 1, right? Then for track 2, remember to identify compliance obligations, which can result in the binding arrangement liability. Then determine whether to use overtime or at a point in time. This is for the track 2 revenue, right? Then something very important, update accounting policies. Risk is because we already have IPSAS 23 disclosure notes. Risk is on the face, we put the with binding, without binding, but the notes are not speaking to what's there, right? And lastly, this is something very critical. You need to train all your finance staff, because when you are trained, you are knowledgeable, but you are not doing everything by yourself. You have got a team that you work with. So make sure that every team member is equipped, right? Then lastly, just a summary of everything that we covered, the key takeaways. IPSAS 47 is now a single standard, which has replaced IPSAS 9, IPSAS 11, and IPSAS 23. And there are 2 tracks in terms of accounting for revenue using IPSAS 47, which is the with binding and without binding arrangements. Taxes, fines, and unconditional grants or transfers, those are examples of track 1 model. And when we talk of fees, like license fees, your passport fees, etc., or service charges, and some conditional grants, right? They can feature under your track 2 model, which uses the which uses the binding arrangement model or compliance obligation model. And revenue follows satisfaction of compliance obligations, not receipt of cash. This is just a reminder, right? So in both the tracks, it's not only for track 2, but even for track 1, you would realize that revenue recognition follows the satisfaction of the obligations or conditions here, these conditions, right? And lastly, binding arrangement liabilities will materially affect public sector balance sheets because previously most people were not including these. So obviously your balance sheet will have more liabilities. When you were used to recognizing everything as revenue, like for let's use that example, you receive the 2.4 million, everything is revenue. If you recognize everything as revenue, then it's cash, debit cash, credit revenue, no liabilities. But now, because there is a liability that you need to bring out, it will affect the structure of your balance sheet. So as I close, please, IPSAS 47 is effective or was effective 1 January 2026 rather, right? And entities should actually be implementing it now. Full compliance by now is expected because we learned the standards, or it was when it was issued 2023, 24, 25. So by now we should all be fully complying with this standard. Right. This brings me to the end of my my presentation or this webinar. Madam Tari, over to you. Do we have any burning questions that we need to attend to?
Thank you so much, Mr. Dandira. I think everyone can testify. This was a really insightful
Sorry, I
session.
can't hear you.
Hi, Timothy.
I think something is wrong with my device.
Hi, Timothy. Please just let me know if you can hear me. Anyone from the...
Tari can hear you. I think it's from Timothy's side.
Okay, thank you for that, Sir Chris. Just wanted to thank you so much, Mr. Dandira. I think everyone can testify that this session was really insightful and how you took us through the two-track model, binding arrangements, non-binding, and especially the part where you're actually detailing how to recognize and the measurement as well. And for everyone who was then asking pertaining to the recording, to attain the recordings, they will be uploaded on the IPSAS learning management system, and we can access all the recordings on the IPSAS LMS platform. So they will, as soon as we are done with this session, they will be readily available for everyone. And we'll just take a pause a bit to just scan the room, our IPSAS 47 room, to say, do we have any burning questions per se? As I do take stock that some of the questions were being answered as we moved along. And we do apologize that we are slightly over time, but I think it was really well worth it for us to really go through that detail, and especially where he was rounding up pertaining to what auditors need to have a look at, or what the preparers need to make sure is addressed before audit altogether. Let me just check the question and A. If there are any questions, are we going to provide slides for this presentation? I think slides will be provided for you together with the recordings, and we can access all this information on the learner management system, on the LMS, the IPSAS platform altogether. So yes, the information will be provided to you at the end of this segment. Okay, Pascal, I don't see any burning questions. Pascal, are you there? I know you had an announcement for us. You may take over.
Yeah, I think there is one question that I think it's important. It's hidden in there.
Okay.
The question is, are all the 5 steps still on recognition, or some are already into measurement? I think it's really important. I feel like it's coming from the section where I was addressing the where I was addressing the track 2 accounting model. So this is a question from someone who is used to seeing the standard clearly stating the classification bit of the standard, the recognition, the measurement, the presentation, the disclosure. So it's important to note that, yes, IPSAS 47 may not distinguish between those sections, but what you realize is the 5-step is actually a summary of that whole process of starting from classification, because the moment you say let's identify the binding arrangement, already you are dealing with the definitions, which is addressing your classification. Then when you say, okay, let us identify the transaction consideration, you are already at a step where you are dealing with measurement. So it has got the classification, it has got the measurement. And when you talk of step number 5, revenue recognition, you can't recognize revenue when you haven't satisfied the compliance obligation. So you need to link the step number 5 to step number 2, which means step number 2 and 5 are helping you to recognize your revenue, because you only recognize revenue when you have satisfied a compliance obligation. So those two will link. So you will see that even though the standard haven't clearly said this is classification, this is measurement, but you can see, because you now know what measurement is, you can see that, okay, where we are talking about transaction consideration, step 3 and 4, it's actually your measurement. Thank you for the question.
Right. Thank you for that as well. I did do another scan, and I see one more question for you, Mr. Dandira, is if you can also upload the material on the LChat platform as well for that. Okay.
Thank you. That has been taken note of.
Okay, great. Pascal, are you there? Over to you for your announcement.
Good afternoon, Teddy. Thank you for the opportunity. So it's just not a big announcement. It's just a few things that I just want to lay out that the institute is doing prior to the improvement of your professional skills and all that. So right now the institute has what we call a learning platform, which is an LMS that has more core professional skills that you can actually make use of to as you're doing your day to day. So if you can just go on our website, that is icas.org.zw. I think I've posted the website link in the chat box, which is icas.org.zw. What you need to do, you just sign in. If you are a member, you just sign in as a member. If you're not a member, you just create an account as a non-member. You go to your account. When you get to your account, that's where you will see the recordings of all these webinars that we have been doing. So many of you have been asking, are we going to get the recording for this and all that? This whole webinar will be on that. So you just go on our ICA's website, create your account if you're not a member. If you're a member, just sign in and go to your account, and on your dashboard, you will see the recorded webinars that have been done. But prior to what I'm talking about, which is the LMS courses that we have, you on your dashboard, you then click online courses portal. That will be just below your profile photo. Then you click the courses. So we have courses that that are around artificial intelligence, MS Excel courses, project management courses, leadership and HR courses, soft skills courses. We have the financial management courses, corporate governance courses, digital and technology courses and also ESG courses that you can take. So kindly note that all these courses on our ELMS platform, they are self-paced. You can do them as you go, and as you do them as you go, they cost as little as $30, $30 up to about 155. So when you just log in, choose the course that you want, make your payment over that site, and you just take the course over as you go. So once again, how you can log in and how you can do it, just go to our website. I've sent the link in the chat box. If you are a member, just go to sign in into your account. If you're not a member, just make sure you create an account. And after you've created an account, go to your account, click on line courses just slightly under your profile photo or your profile dashboard, and you click courses and then select a course that you want. From there, that's our LMS platform that we have. And for all the members that we have that are part of this webinar, we are going to have our third edition public sector professional accountants workshop. Currently, the venue has not been set as you determine it. So please kindly just fill up the survey form that has been posted in your membership WhatsApp group, and it will help us to see what you really want and where you want to go for that whole cozy, classy workshop that you have as the PSPAZ members. But over and above as the institute, again, we have our winter school, which is coming in end of next month. So registration is closing on the 26th of June. So kindly go to our website, take a look at the winter school tab, and just look on the package that you want. It's in Victoria Falls this year, and just register before the deadline pass, which is the 26th of June. So for now, I'll just leave this time again to Tari. Um, Thank you so very much. As we leave it to Elchat.
Thank you for those announcements, Pascal. And I think without wasting any more time, I would also like to just thank the institution for allowing us and giving us this platform for our continuous development. And I think today's
There will be a short presentation which is going to come from Shami before you close.
all right, Shami, you can take over before my closing.
Shami. Shami.
Oh, can you? Can you
I
hear me
think
now? Hello?
yes, Shami,
Can you
you
hear me
can go
now?
ahead. Yeah, we can hear you now.
Thank you so much. I think it work. I was saying for the sake of time, I'm just going to share it as a sort of a presentation so that of
All right, it's fine.
so we are inviting all aspiring to be PSPAZ professional account to join us with the July intake, and applications are still inviting all are not yet in the program. Us, we provide tuition as Ultra Business and IPSAS is the accrediting board. So we're inviting all July into having new charters with tuition.
Thank you so much, Shami. Over to you, Tari.
Shami and Pascal. I think we've had an insightful morning and afternoon. I would also like to thank the institution for providing this continuous learning and development as we move along, especially in just strengthening the credibility and transparency in reporting for our public sector altogether. Ladies and gentlemen, good afternoon, and thank you for affording the time to be here. Enjoy the rest of your day. Thank you. Cheers.
Thank you.